What's up, strangers? Welcome to the Wealth Game Nation. My name is Vedo and I'm here to help you better understand the wealth game and become part of the Wealth Game Nation. In today's video, I will make a prediction. Yes, you've heard that right, a prediction for 2023. I will predict for you how the economic situation and the stock market will look like at the end of 2023, so essentially a year from today. Don't worry, my prediction does not come from a magic ball, but rather I will guide you through the data I have collected and analyzed, and I will show you why I am predicting what I am about to predict for you. In a year's time, I will make a review video and we can all see how I did. I am excited, so let's get right into it. On today's agenda, we will look at the different factors that will impact the world in 2023. We will put the pieces together and we will solve the mystery. Then I will make my prediction for 2023 and then I will tell you about my plan. Let's look at the different factors. Some of the major factors that will impact the year in 2023 are the gross domestic product, or the GDP. This is essentially all the goods and services that a nation produces. Then there is the consumer price index, or the CPI. This is basically used to measure inflation. Then we have the stock market, bond yields, housing market, interest rates, money supply, jobs market, and last but not least, war. If we look at this graph right here, this is the S&P 500 index for the last 95 years. The blue line is the growth of the S&P 500. The grayed out bars are recessions. If we look closely at the graph, we can see that the recession is followed by a drop in the stock market. This has been the case for most of the recessions and the stock market drops. However, there have also been some anomalies. So we can see that, as the great Mark Twain said, history doesn't repeat itself, but it often rhymes. Now, let's put the pieces together. So we will look at the factors and how did it play out in 2022. Number one, gross domestic product, or GDP. Q1 and Q2 were negative, Q3 was positive. Q4 is still outstanding. We will get this data next month. If we look at the graph on the right side, 2 quarters, as I said, Q1 and Q2 have been a little bit beneath the zero, and Q3 has been a little bit above zero. Then we have the consumer price index, or the CPI. As we said, this data measures the inflation. Inflation has peaked in July at 9.1%. This is the highest inflation rate since the last 40 years. If we look at the graph below the table, we can see that right now we are about 7.1% inflation. So we can see that the inflation is coming down. Next up is the stock market. The S&P 500 is down by almost 20% at the time of this recording, and Nasdaq is down by over 30%. The bond yields are around 4%. We can look at the illustration to the right. We can see that all treasury yields are around 4%. The housing market is going down. The interest rates are currently between 4.25 and 4.5. If we look at the graph below the table again, we can see that since the great financial crisis in 2008, the interest rates have been virtually zero. Then they started going up slightly because the Fed saw that inflation was getting higher. But then we all know what happened. March 2023, the world shut down, and the Fed, and also what is relevant for me, the European Central Bank, has put rates back to zero. Now, in 2022, interest rates have been going steadily up. The money supply, we have currently quantitative tightening. This is when the Fed is selling off its asset, basically removing money from the circulation. The job market is currently at 3.7%. There is a massive tech layoff, and we have war. The Russia-Ukraine war has also peaked in 2022. Now, I will make my predictions for 2023. For the GDP, I predict that the first half of 2023 will be negative and then will become positive. In the whole list of my prediction, this is the prediction that I am least confident about. However, it does not really matter because whether it's just a little bit below zero or just a little bit below, it is fairly insignificant. The CPI, looking at the graph, how inflation has peaked, I believe that the inflation will be between 3 and 4% by the end of the year. This is based on the graph we saw before. The inflation peaked in July, going down steadily. I think this is where we'll end. The stock market, I think the stock market will keep going down, at least in the first half of the year. I believe the S&P 500 may go down by 10%. I believe also that the Nasdaq might go down even by 20%. And I believe these are worst case scenarios. The bond yields I believe they will be below 4% at the end of the year. The housing market is gonna keep going down because the prices of real estate are anyway way too high. The interest rates, if nothing major happens, the interest rates will be at 5% or higher. Monetary policy, I think we will continue with the quantitative tightening. The job market, I believe it will be above 4.5%. This is because even the Fed said that this is what they are targeting in order to combat inflation. And the war between Russia and Ukraine will slow down. However, it will not be resolved. This will be a conflict for a long time. Now let's look at this graph. This is a simple graph, but a very, very important graph. I wish I knew this 15 years ago. This graph shows us the economic cycle and it has 4 phases. There are 2 phases where everything is going up, recovery and expansion, and then 2 phases where everything is going down, slowdown and recession. What I mean by everything is going up, I mean all the positive things are going up, such as the GDP, the stock market, the housing market, money is being printed, job market is strong, and everything that is negative is pretty low. Then slowly, by having all of that positivity, then this creates inflation. When inflation goes up, then the interest rates start going up. And then we come to a slowdown and eventually to a recession. This is, again, as we discussed, when everything what is positive starts going down. So the GDP goes down, the stock market goes down, the housing market goes down, the job market goes down, and the bad things go up, such as interest rates, the CPI or the inflation, and so on. Now I will tell you what is my plan for 2023. Right now, I think we have already identified the cycle. We are currently at the 4th stage. Basically, we are in a recession. 2023 will be a recession. Where are we exactly on the curve? Nobody can tell you. In the 2 latter stages, in the slowdown and recession, I think in those stages it is important to invest more and have less cash. So what I will do is continue to dollar cost average, however, at a lower pace. That is, at least in the first half of 2023. I will keep adding to my war chest, basically increase my cash positions, again, at least in the first half of 2023. Then, in the second half of the 2023, I will increase my deployment into the stock market. So far, I haven't pulled out any money out of the stock market, nor am I planning to do. However, now that I believe the first half will be going down even more, I will not be putting as much as I usually would, and then I will again step it up. In the future, I think it's important to ride the wave and don't be under it. It is important to identify all these different macroeconomic factors and know where we are in the cycle. That means during recovery and expansion, less deployment into the market and more hoarding of cash into a war chest. I know that this is on the contrary of what most people are saying. You know the catchy phrase, cash is trash. However, if you look at Warren Buffett as a case study, you can see that Warren Buffett has underperformed the stock market in the last 10 to 15 years, basically since the housing crash of 2009. This led to many newer, younger investors saying that value investing, Warren Buffett and everybody who does it are relics of the past, that they don't understand today's world. This is because the younger people do not understand the economic cycle. Then if you look at Warren Buffett, for the last 15 years, he has had over 30% of his portfolio in cash. In theory, yes, that cash is valued less because it's losing money because of the cheap loans, but Warren Buffett has never explained himself why is he hoarding so much cash. The only thing he ever said is there is currently nothing for the price that they are willing to pay. Fast forward to 2022, Q1, Warren Buffett has gone, quote unquote, on a shopping spree. He has spent over 45 billion out of his 160 billion cash reserve. This basically proves my point. During the good times, he's letting his investments do the work and he's collecting money. So when everybody said cash is trash, he's hoarding cash. Now that everybody is saying cash is king, another catchy phrase, he is deploying quite a lot of his cash. So that's it. If you find value in this video, I kindly ask you to like this video, subscribe to the channel and share it with your friends. This helps me a lot when you guys do it and it does not cost you anything. No need to smash anything, gently clicking will do the trick. And now, you tell me, what do you think about my 2023 prediction? Give me a feedback, I would love to hear from you. Thank you so much for watching, I hope you enjoyed it, and I will see you in my next video.